In this example, we're going to look at another issue of bonds using the straight line method. And this time, we're going to be looking at what happens when we issue at a discount. So we have Ruff Corporation, and they issued $8 million in 6% 5-year bonds on March 1st at 92. So the $8 million is our bond issue amount. The 6% is our face rate, the amount that will be used to calculate interest, and they are 5-year bonds at 92. So that 92 tells us they're going to be issued at a discount because it's below par, it's below 100. So we're basically issuing them at 92% of their face value. We also have semi-annual interest payment dates, which means since it's a 5-year bonds, we'll pay interest 10 times. And those dates are on September 1st and March 1st. So we're going to do some calculations and prepare the journal entries to record the issue of the bonds and then to pay interest. So the first thing we want to do is we want to calculate, for the issue of the bond, we calculate the amount of cash that we're going to receive. So we're only issuing them at 92%. So we'll calculate 92% of the $8 million to determine the amount of cash we will receive, which will be our debit to cash. And then the unamortized bond discount amount will be the difference of the issue price and the amount of cash that we receive. So you can see here that we'll debit cash on March 1st, the day we issue or sell the bonds, for $7,360,000. Bonds payable, always, no matter whether we're doing a premium or a discount, will be credited for the face value, which in this case is $8 million. So the unamortized bond discount will be debited for $640,000. So now we're ready to look at the payment of interest. So when we pay interest, we have to look at the amount of cash that we will distribute. Okay, so the $8 million times the 6% divided by 2, because we issue every 6 months. So you could also take 6 divided by 2. And then we're going to look at unamortized bond discount. So remember, we have $640,000 sitting in our unamortized bond discount account. That needs to be 0 at the end of our 5 years. So we're going to take that $640,000 and we're going to spread it out over every time we pay interest. So we take the $640,000 divided by the 10 periods, because 5 years pay twice a year. So when we do our journal entry to pay interest, we will credit the unamortized bond discount by $64,000. And when we do that 10 times, because we're going to do this journal entry 10 times, that account will then become 0. And the amount of cash paid out, $8 million times 6% divided by 2 is $240,000. So then our bond interest expense will be debited for the sum of those two. Now for the second interest payment, since we are using the straight line method, it's exactly the same. So we debit bond interest expense for the sum of unamortized bond discount and credit cash. And remember, when you calculate cash, it's always the face value times the face rate divided by 2. Divide by 2 only if it's semi-annual interest payments. If we were to pay quarterly, that means we would pay every 3 months or 4 times. So you would have to change that. So then again, the unamortized bond discount, we take the balance of $640,000, split it up over 10 periods. So now after 2 interest payments, my unamortized bond discount account has been decreased by $64,000 and $64,000 again.